Hey everybody, Coburn Sheppick here. I am so excited to be here today as this is our first Zoom meeting for the Limited Partners Club. So just to give a little insight, we've created this community, a members-only community for sophisticated investors that are focused on private markets. So we've developed this community for investors that have interest in connecting with other like-minded families that share an alignment of interest to talk about markets, discover opportunities, and make quality connections. And so we plan on doing this recurring meeting online as well as in person. Hopefully soon. We're actually planning to launch our chapter in Scottsdale, Arizona later this year, and we'll be hosting private dinners and some exciting things to come. So I'll get into that a little bit later. I've got an invite for you. And in today's discussion, we're going to be talking about the state of the market and how this intersects with commercial real estate. There's a lot of crazy stuff going on, as you know, so I'm very excited for this conversation today. So we're going to dive right into it. A few of the topics we're going to cover: the state of the market, of course, what's going on in the economy, and how this intersects with commercial real estate. And at the end here, I've got an exclusive invite that I'm going to share with you. So starting with the market, as we know, we've got a severe inflation problem going on, and the Fed obviously is using its tools to combat this. But August CPI clocked in at 8.2%. which is, again, setting new records over several decades, almost 40 years now. And so how did this happen? Over $3 trillion were pumped into the market when the pandemic happened. And the scary fact of that is almost more than 20% of the total dollar circulation was created during that 3-year period, and everybody got a check in their pocket, and everybody it did serve a purpose, of course, because people lost their jobs, businesses shut down, and so it did serve a purpose. But now we're actually beginning to pay for that, and so there was also a lot of big companies that took millions and millions of dollars and reinvested it. Obviously, they had to, pay for employees, and there was, a purpose behind that. But there was a lot of fake money being pumped into the market. And so, what did this do? People invested it. The stock market exploded, and real estate asset values also exploded. And so, when there's inflation, there's value disruption. Things go up in price when there's bidding wars. And fake money being pumped in the market, especially alongside with historically low interest rates. When the pandemic did happen or did begin, the Fed dropped interest rates down to nearly zero, which incentivized buying and investing, and continued the major expansionary period that we had. It exploded the entire investment market, and so now we're catching up to that. And so here we are with interest rates moving quicker than they have historically almost ever. And so it's the end of September now, and the Fed just raised rates again, 75 basis points. 300 basis points this year, and we're obviously expecting more of that to come in 2022. Now, if you're looking at the chart here on the right hand of my screen, you'll see that we're still historically at low levels. And so some might argue that rates will come back down. It's an unknown. There's a good chance to that because they were so low for so long. But then again, this period since after the financial crisis, for the past decade, rates have been down to the lowest point it's ever been. And so during that whole period it was the longest expansion period almost in history. And so that created values to continue, building to continue, investing to continue, etc. And now that rates have jumped up so dramatically in such a short period of time, already asset prices were pumped through the roof. One, because of the length of the expansionary period. Two, because of the amount of capital being pumped in the market. And three, interest rates being at nearly zero for so many years. And so now that interest rates are climbing at the rapid pace they are, this is putting major upward pressure on cap rates, which were so compressed over the last few years. We've seen value add, multifamily, old properties in secondary markets with not very great tenants trading for in the low fours, even the high threes, which is unheard of. And now that rates are climbing, there's definitely upward pressure on those rates. We're already seeing it, and there's even negative yield in year one returns. And so year one cash flow has pretty much been non-existent for a lot of the deals that have been done during the past couple of years. And so interest rates will continue to climb. This is going to keep adding pressure, and we'll talk about in a minute what we see happening. So we're not talking about the housing market, but these statistics is a big part of the economy, and it does affect the rest of the market. So if you're looking at this chart, which is by Marcus and Millichap, showing the spread between monthly payments in the average apartment and the average mortgage payment, and you can see that there's over $1,000 spread. Mortgage payments are that much more expensive because of the values alongside interest rates climbing. So affordability currently is the lowest it's been since 2006, before the financial crisis. Does that mean anything? Does it mean we're going into 2008 again? Not necessarily, but it means that there's an affordability problem, and that needs to be corrected. And that's obviously what the Fed is doing, and they're correcting it. So alongside with inflation and interest rates, there's been massive migration after the COVID pandemic. I'm in Phoenix, and we've had massive amounts of in-migration, and places like California and New York have had lots of people moving away. And so the Sun Belt has turned into a very hot market, obviously. Texas, Florida, etc. And this has increased the demand for rental property and new construction in a lot of these markets. And so all of this combined with interest rates being low for so long, incentivizing investment, as well as the dollar inflating, has pushed asset prices even further in these types of markets. So what's next? This is the topic. We are at risk of a recession. Are we in a recession? I would say we are. Historically, a recession has been defined as 2 consecutive quarters of negative GDP growth, and that we are about to go in the 3rd quarter of negative GDP. And so it's defined in a gray area now, but you can see one of the indicators or red flags that economists use, and I am no economist, but we're just looking at this data understanding it and using it to make assumptions for what's to come. But the inverted yield, if you're looking at this chart, we have inverted. And if you look at historical years, each time we've inverted, we have came into a recession after that point. And so that is a big indicator of what's to come. Does it mean we are for sure going into a recession? Not necessarily, but the fact is that we are in the largest debt cycle in history, with the amount of money that's been printed, etc. So there is a massive risk for a recession, and energy prices, for example, with what's going on in Ukraine and Russia, and now we've got potential war. So there is a big risk here, and this is unlike anything that has happened. I'm not trying to be Dr. Doom here, but all the pieces combining are creating a big stir here. And so we are at Dovetail actively waiting to see what is going to come from this 300 basis point increase. Aside from everything else that's going on in the global economy, just that increase alone is going to create major impact, and we'll get into that in a second. So how does this all intersect with commercial real estate? What's to come? What do we think of this all? First of all, there has been massive supply chain disruption, which has created a major cost to building and labor. After there was many layoffs, jobs have now just began to get back to pre-pandemic levels. And now we're already seeing layoffs again because of interest rates climbing. So the price of lumber has now gone down, and that's a signal for demand disruption. They're trying to, when prices like that come down, it means that there's a demand disruption as well. So as far as the capital markets credit is now becoming scarce. We're seeing debt coverage ratios go way down, and the ability to get loans, for example, and as far as mortgages, applications have gone down dramatically, obviously because of the interest rate shift. And now what we'll see after a period of major, I hate to use this word, but major, people have, newbie investors and even veteran operators have become so focused on future projections that are unrealistic based on what has happened during the last couple of years, with massive rent growth. For example, in Phoenix, where I'm based out of, rents have gone up 30% in some cases, and that's unsustainable. What has happened is operators have gotten used to this massive jump, and they're buying at extremely low cap rates and projecting that rates will continue to climb, rental rates, and that is speculative thinking, because what has happened during the last couple of years is not traditional, and there's many reasons for why that happened. Mostly because of the massive amount of money printing that has gone over the past few years. So we see, and we're already seeing it, the capital that has been allocated to those value add growth type of deals will be seeking new stability in assets like single tenants or net leases, where there's longer term leases and more creditworthy tenants. So the smart money is going to follow stability during this time of extreme uncertainty. And with interest rates rising, and with a major inflationary period and stagflation, we'll probably see some downsizing. And so what does that mean? It could mean even more. It could mean more apartment demand. That doesn't mean rents will continue to climb. In fact, rents have started to decrease again. But it could mean more renters, and it could mean downsizing, and that also could mean demand for storage. But then again, people are going to start wanting to save money and cut down expenditures. So it'll be interesting to see what happens when the wealth effect kind of turns here. We're already seeing some abandoned development sites. You'll see it on the headlines. A few of the big builders have. What's going on with interest rates put a big damper on construction, and so it's easier to hold the land and stop construction potentially as the exit has changed dramatically, as well as the cost to build. So there's going to be a lot of, I think a lot more abandoned sites, single family sites, multifamily sites, etc. And we talked about this earlier, but there is negative yield right now. Buying at extremely low cap rates with higher leverage and increased rates are creating negative yield in year one and year two returns, which is a major red flag. And what we'll see happen, especially in the cases where there is bridge debt or short-term bridge debt, which a lot of deals have occurred, where back to the operators that are projecting continued rent increases after this massive growth period, and that do have negative yield, are using bridge debt at high leverage. Maybe it's interest only, and their plan is to add value and refinance in 12 to 18 months. And with that refinance is going to come major challenges because of the current capital markets. It's going to be challenging, one, to be able to get the values needed to refinance at their high leverage, and two, so what's going to happen there is there's two things. There's either going to be defaults or there's going to be capital calls. And if there's capital calls, meaning that investors need to fork up more capital to fund that deal, alongside with cap rates rising and interest rates continuing to climb for the rest of this year and into next year, there is going to be a lot of equity wiped out. And it's an unfortunate thing to say, but it's true. And so it's either defaults or capital calls and equity being wiped out. So what this all means is opportunities around the corner, and all these parts coming together. And this, it obviously depends on the market, depends on the time, it depends on the asset, but in these cases where values have been disrupted so much and there is marginal deals happening, people are overpaying for assets, especially that are high leveraged, that have a plan, a shorter term plan, less than 3 years. A lot of those deals are going to go bust. And so the opportunities in those cases are recapitalizing, even obviously taking assumable loans after the great mortgages, the great debt that has been available up until a couple of years ago, or just this past year, I guess. But assuming those loans, recapitalizing the operators that have been over leveraged and that won't be able to refinance, and we will see bankruptcies, we will see equity being wiped out. And so we are waiting and prepared for this to come full circle, and it will. It's a matter of time, and I hope that people don't get too hurt, but it is going to happen. It's unfortunate. It's part of this. It's part of this business, and so that's why it's so important to focus on the basis, the buy-in price, having a healthy spread between interest rates and cap rates. In recent cases, there's been negative spread, which is an immediate red flag. And so there most definitely will be opportunities around the corner. And for this to go affect more than just those shorter term deals, it will take time. But I believe that we'll start seeing this sort of come around in those short-term deals within the next 6 months. And so we have a close look on that in various growth markets that will definitely be prepared to take action. Crazy times. Okay, so I want to take this time to give an exclusive invite. We are launching this community, and it's a free community. We are focused on building a quality network of sophisticated investors that want to be connected with other like-minded families. We're doing these online meetings as well as in-person private events. This is a members-only community, and so if you'd like to join, go to limitedpartnersclub.com and you can request to join. We have developed an online space that individuals and families can connect, and we'll be hosting these meetings in that space, as well as announcing in-person private events in that space as well. So I want to invite you to join. I'd love to meet you, and I'm excited for the future and what's to come. Thank you so much for being here and spending the time today. Definitely crazy times, and we'll continue this discussion. So thank you, everybody. Bye-bye.